And all it takes for gold is to break through this $2,070 level. I think that's what really is the most important question for gold. When will this happen? Will it happen now in the next few months, or will it take maybe another half a year or a year of consolidation? But overall, that's, I believe, what's going to happen and what will catapult gold much higher in the mid to the longer term, let's say over the next 2 to 3 years. Because once you break out of this resistance level, sky is the limit. I think $2,500 will be seen very quickly. And then over the following 2 or 3 years, we could easily go to $3,500, $5,000. It's all possible because this formation here has been 12 years in the making. There's been a lot of energy being compressed.
Gold prices fell on Wednesday, weighed down by an uptick in the dollar and U.S. Treasury yields after minutes from the Federal Reserve's June policy meeting cemented expectations that rates will stay higher for longer. Spot gold was down 0.5% at $1,916.49 per ounce by 2:32 p.m. EDT, 18:32 GMT. U.S. gold futures settled 0.1% lower at $1,927.10. A United Fed agreed to hold interest rates steady at the June meeting, according to meeting minutes released on Wednesday, even as the vast bulk expected they would eventually need to tighten policy further. Benchmark U.S. 10-year Treasury yields jumped to a near 4-month peak after the release, while the dollar rose 0.3% against its rivals. Traders are pricing in an 89% chance of a 25 basis point hike from the Fed in the July meeting after last month's pause, per CME FedWatch tool. Gold has been in some form of consolidation since 2011, says Florian Grummes, managing director at Midas Touch Consulting. Speaking in his recent interview, Grummes explains that gold is gearing up for a phenomenal breakout, but it needs to tackle this technical level first. Grummes also discusses a pivot by the Federal Reserve, the U.S. dollar, and what to expect from the rate hikes. As we now go into the video, make sure to like, subscribe, and drop your comments below.
And gold went up massively from 2001 until 2011. 10-year bull market, it went up 670%. And so you can see that it's not what they tell you nowadays, that gold is going nowhere. I mean, gold can make big moves and has done so in the past. Of course, and that is a very important top here, the red arrow. This is the top in 2011. This is now 12 years ago, 1920, and that's exactly where we are trading right now. That's been the top in 2011 after a 10-year bull market. And if something goes up so steeply, it has to recover, it has to digest, it has to consolidate. And that's what happened. And gold went down nearly 45% over the following 4.5 years, only to reach a bottom here at 1,045 in December 2015. So this is 7 years ago. That was your last best buying opportunity in the gold market. And since then, gold recovered and has reached, again, a new all-time high, 2017. This is 3 years ago. And as you can see, it's been running against this 2070 dollar mark, resistance mark now for the third time, just recently in early May this year. So this is just 2 months ago. Gold reached $2,070 again, and it failed. It came back down, and that's exactly the correction that happened that you just described, and that took gold back down to 1920. So this is the very big picture. I believe that since 2011, over the last 12 years, gold is in some form of a consolidation pattern. And if we're going to zoom in a little bit further, and that's the weekly chart, so you're going to have the top in 2011 here on the left side at $1,920. You have the low at $1,045. This was December 2015. And you have the top in summer of 2020, a few months after the Corona crash happened and the central banks flooded the market with money. Gold went up to $2,075, reaching a new all-time high. And since then, again, it's correcting and consolidating. We had another run during the Russian invasion. It went to 2070, and then last year we had this steep pullback when the central banks started raising rates in America. And now just recently gold is back up at this 2070 resistance. So what I want to tell you on this chart, we are most likely seeing a so-called cup and handle formation. And all it takes for gold is to break through this $2,070 level. I think that's what really is the most important question for gold. When will this happen? Will it happen now in the next few months, or will it take maybe another half a year or a year of consolidation? But overall, that's, I believe, what's going to happen and what will catapult gold much higher in the mid to the longer term, let's say over the next 2 to 3 years. Because once you break out of this resistance level, sky is the limit. I think $2,500 will be seen very quickly. And then over the following 2 3 years, we could easily go to $3,500, $5,000. It's all possible because this formation here has been 12 years in the making. There's been a lot of energy being compressed. And as you can see also on the left side, the top from 2011 is more or less in the same region where we have this resistance now at 2070. So I think it's a very big consolidation pattern in the gold market that is about to end. And it could end now in the next 2 3 months. Maybe it takes another round of consolidation. Maybe gold wants to really shake off all the weak hands in the next few weeks. And maybe with those 1 or 2 levels lower, maybe 1850. I don't think it will go much lower than 1800. That's really my worst case nowadays. But that's the big picture in gold.
There are 2 main causes for higher than normal broad money supply growth, which tends to be inflationary for consumer prices when it happens. The first cause is rapid bank lending, which tends to be tied to demographics. The second cause is large monetized fiscal deficits, which tend to be tied to conflict. In addition to instances of conflict, large fiscal deficits can also be tied to demographics as well. For example, a large generation enters their retirement years, which is now happening to the baby boomer generation. Grummes sheds light on de-dollarization, market outlook projection, rate hikes, and inflation.
Remember that since the end of the gold standard in 1971, this currency system is backed by nothing than the faith of the people and the force of the state. And now it takes much more than the last time to rescue the system. As I just explained, over the weekend, they decided 400 billion in rescue packages very quickly. And the next time they will have to come up with even more, because this is a fiat system backed by nothing. And it will repeat itself again and again and again. The only question is how long it takes. And of course, the dollar is a very big and the most established currency system over the last 50 to 80 years. So it might take much longer than in a small country like Venezuela or Zimbabwe. But in the end of the day, it all depends on psychology. And it's just a question of perception. And as you've realized over the last few months, the de-dollarization topic popped up rather violently, and lots of people discussed it. Yeah. And I think it's obvious that we have a break between the East and the West. There's a new Cold War already going on. And the BRICS countries trying to move away from the dollar. And I think things are accelerating, but it's a process that might take the next 10 years. Huh? Right now, obviously, we are in a seasonally a little bit challenging period the next 2 3 months. Usually the stock market can have some problems towards and into September. And we have a very sharp rally over the last few months, so I wouldn't be surprised to see some weaknesses and pullbacks. It's certainly not a good time to step into the stock market right now. However, I think once we have the slightest problems in the market again, you will see the Fed being forced to come up with the next rescue package rather very quickly. So I don't think that we're going to see a longer kind of like correction or bear market like that could last another 1 2 3 years. It could be a matter of a few weeks, maybe 1 2 3 months, pullbacks, yes, but not something much longer, because it will actually risk that the system is completely imploding, and the Fed will not be willing to accept that. I think that they have stopped. If they would break another 1 or 2 times, okay, I don't think it makes a big difference, because we're already at 5% and higher. So the large chunk of it has been done. I personally think they have stopped already. And I think that rather sooner than later, probably, let's say, towards end of the third, fourth quarter, they will be forced to cut rates again. We're going to see, and that's, by the way, part of the crack-up boom, right? I mean, this is a beautiful way to explain that on the one hand, you have rising stock markets, while the real activity or the activity in the real economy is actually not really that good like you would think if you look at the stock market. So you're going to see more and more problems cracking up in the real economy over the next few months, I guess. And at some point, then the Fed will be forced to lower rates again. Banks that have been failing in March, but it's also Vice Media, if you remember, they went bust. And overall, it's this number has doubled in compared to the same period of last year. And it's the highest number of fillings since 2010. So there is something brewing which you don't really see in the news, and which also is not shown by the stock market data. By the way, one thing we also have to mention about the rally in the stock market, it's not a very broad rally, right? It's focused on a few selected stocks and on the AI boom. Most of the other stocks have gone nowhere or lower. So it's not a very healthy market in general.
In an interview with Fox Business, Larry Fink, CEO of BlackRock, the world's largest asset manager, drew parallels between Bitcoin and gold, claiming that the cryptocurrency is digitizing gold. Since the start of 2023, Bitcoin has made an impressive run, posting an 83% rise. This move is particularly noteworthy considering a significant portion of the gains happened after BlackRock applied for a spot Bitcoin Trust ETF in mid-June. The firm's application stands among many others from industry heavyweights such as ARK, Instress, Eco, Vanek, and Grayscale, who are all seeking regulatory green lights for similar crypto products. BlackRock has a strong track record with the Securities and Exchange Commission, SEC. Of the firm's 576 ETF applications, only one has been rejected. This strategic move showcases BlackRock's commitment to crypto adoption and its determination to work alongside regulators to develop solutions for crypto-based investments. Fink believes in the potential of tokenizing assets and securities, seeing it as the next revolution for the finance industry. The company is optimistic about making investing more accessible, specifically for Bitcoin and other cryptocurrencies, with its ETF offerings. The BlackRock boss outlined that the costly bid-ask spread for cryptocurrencies would be reduced, making transactions less expensive and ensuring more profits for investors. Fink envisions this democratization of crypto as a step towards increased financial inclusivity. Initially, Fink shared some skepticism about cryptocurrencies due to their early adoption for illicit activities. However, he has since shifted his perspective, recognizing the value of Bitcoin as a hedge against inflation and as an international asset not tied to any one currency. Despite the skepticism about the utility of the underlying blockchain technology, Fink sees the potential for the technology to improve transaction speed and traceability, effectively replacing some traditional financial intermediaries. Despite this, he admits the world is not close to reaching this point yet, implying there's much more room for growth and development in this space. What is your prediction for the gold price? Let us know in the comments section below. Also, make sure to like this video, subscribe, and turn on your notifications. Thanks for watching.